Hello and welcome to another District Capitalized Money Monday. Today is September 26th, and from DSLBD, we're bringing you Crowd Building for Capital. It's a pilot, and we're having our fourth and final webinar called Crowdfunded Equity Investment with WeFunder, presented by our partners 20 Degrees, the Marigold Effect, and we'll have WeFunder joining us as well as the DC-based businesses going through crowdfunding Bison Venture Partners. Hello, I'm Camille Nixon. We're glad to have you here. Next slide. Just some housekeeping. This is general information about financing, specifically crowdfunding. It's not specific financial guidance for your particular business. We are recording this session, as you can see, and we'll be sending the handouts and recordings later. If you prefer not to be on the recording, feel free to use the chat to ask questions, or you can email us with questions about this webinar or in general about your business to inno.ed@dc.gov. Next slide. I'll pause it for a second. Jumping back to translations, thank you. In case someone's watching this on the video or for future live events, we're happy to give translation services and ASL interpretation services, as we're joined by 2 interpreters today. So feel free to connect with us for DSLBD and any DC government agency activity. We want to make it accessible to you. Next slide. A little bit about DSLBD and Inno.ed and myself. The Department of Small and Local Business Development, we're a DC government agency that helps businesses at all stages to open and grow in the District of Columbia. We have several teams to support that, including the Innovation and Equitable Development team. We provide lots of trainings, one-on-one coaching, funding through grants and loan supports, and through programs like this. We're always looking for ways where we can further help businesses and do so in an innovative and equitable manner. Next slide. This is part of our District Capitalized program, which is our coordinating program to connect DC-based businesses and DC residents exploring entrepreneurship to financing products, be they grants, loans, rebates, guidance like this webinar, and coaching, and also create an ecosystem of both people looking for funding to connect with each other, as well as with funders and so people who are supporting people pursuing financing. The easiest way to stay abreast of all the great information coming out of District Capitalized is to subscribe to the DC Business Funding Alert. Next slide. So speaking about innovation, and a couple of years ago, we started looking at how we could possibly leverage crowdfunding in general to support businesses. And we saw that crowdfunding is not a popular way that people finance their businesses. Usually it's through bootstrapping or their own finances, a job that they keep, or friends and family. But when we looked at crowdfunding and specifically investment crowdfunding, there weren't a lot of businesses pursuing it. And sadly, even within that space, not a lot of women-led or BIPOC, Black, Indigenous, people of color-led businesses were able to access those financing options. So last year, next slide, please. We teamed up with the National League of Cities, who offered a city inclusive entrepreneurship grant, and applied for it with our partner 20 Degrees and DC Women's Business Center to start this pilot. Next slide. The pilot kicked off earlier this month with a series of webinars with a focus of helping make crowdfunded equity investment an option for all businesses in the district, particularly women and BIPOC businesses, really democratizing the starting line, both for their ability to access the financing, but understand it. We realize these are 2 concepts that might not be something that you're familiar with, but we want you to get comfortable with the option and be able to know if it's great for you now to pursue that, and if it's something that you want to keep in the back of your mind for later. This information will be there so you can know when might be the best time to leverage crowdfunding and/or crowdfunded investment for your business. So we're offering webinars, guides, and coaching. Next slide. We're just at the tail end of our webinars. Today is the last one, but you can watch all of them on our YouTube channel. The website's up there at the top, bit.ly/DSLBD videos. Next slide. And our guides, our partner 20 Degrees developed a great guide, and we're offering coaching, which we'll talk a little bit about at the end. This is coaching to help you get raise ready to pursue crowdfunding in general, and specifically with WeFunder, with the support of 20 Degrees and the Marigold Effect. Next slide. And I'm going to turn it over to my wonderful partners, an awesome team. These are also the team who will be helping you to pursue the crowdfunding coaching that we're offering. And at the end of the session, we'll talk more about that. Sarah, Paula, and Pooja, welcome.
We are delighted to be here with all of you. And Camille, just thank you for this partnership, and to all of our partners here. We're really excited today to talk specifically with WeFunder, as well as we have someone else who'll be joining us for some lessons from the field, so we can reinforce what you'll see, what we've talked about before, but really get into it so you can hear firsthand from some people who have made investment decisions along with our team as well, about how to move forward so you can be so you can be successful in getting the capital that you want after you figure out the revenue that you need. I'm Sarah Gibson. I am the co-founder and CEO of 20 Degrees, and I'm here with my amazing partners, Paula, who is a member of our team, as well as Pooja, who is an amazing entrepreneur and partner in her own right as well. You will hear from all of us throughout the time. Pooja, Paula, if you have anything to add.
Hi, everyone. We're so excited to have you here, and we definitely encourage, if you've missed any of the webinars, to check them out. We want to have as many people apply for this as possible.
Hi, everyone. I'm Paola, joining you from the 20 Degrees team. Very excited to be here with y'all. We just wanted to do a very brief recap of where we've been, what we've done. Today we're here. We made it to the final webinar. We're going to be talking about some crowdfunding investments, and you'll hear from some new voices, and we'll get to answer whatever questions you have about crowdfunding. And application process is being announced today, so definitely stay tuned until the end.
So the first thing we wanted to do is just kick off a poll. So you can go to menti.com, enter that code. And basically we want to just learn, that's okay. How would you, the question to think about is, how would you get your crowd excited about raising capital online? I think that in the prior webinars, we really talked about all the different types of financing available. This one's really going to be focused on equity crowdfunding. But first thing to do is to think about, how do you get people really interested building your community and bringing them online as investors? Okay, we've got one entry: share it on social media. Definitely, we've found that people that have a good online presence can translate that well into directing people that are really interested in their community to the funding platforms. Just give another minute to see if anything else comes in. Luckily, we have a lot of great people here today to talk about it. Offering value that will make life easier for them. Yeah, definitely. We talked about, like, what is your business model's value proposition to really kind of translate to the investor. Friends and family is great. Telling the story. Yeah, we actually heard from some of our participants as well about how effective storytelling really gets people engaged. Incentives. Yeah. So, we can learn a lot from, like, the rewards crowdfunding platforms about how to design a good offering, even if it is more in the investment space. Knowing your value prop, yes. And yeah, I think this is where, like, the LinkedIn profiles, Facebook, TikTok, I mean, it feels like every day there's a new platform we got to be on. But I always tell people, you don't need to be on every platform, but if you decide to use one, which one can you be consistent on and grow an audience there that you can bring there. Yes, live events, physical, virtual. I think, connecting the different spaces that we meet, right? Everybody, I think Zoom and all that has made things easier, but it's made us all appreciate seeing people in 3D even more. Wonderful. Looks like a lot of people are already ready. Maybe everyone can run this webinar for us. Okay, awesome. We can go back to that. So we're going to start with just talking a little bit about what our agenda is today. Like we said, we do have quite a bit to cover. We want to give a recap. Again, suggest everyone check out the prior YouTube videos to get a little bit more in depth, because we will go through those quite fast. But today's really to talk about equity crowdfunding, that one form of investment capital. We're going to have a fireside chat. We have lucky to have somebody from WeFunder here today, as well as a founder, to really talk about what it's like to be in your shoes to raise on a platform. And then finally, we're going to talk about the application process and what the timelines associated with that, and take some questions.
We really believe at the foundation of all of this is knowing your business model and your revenue model. The business model is, what are you doing? Who are you delivering value to? What are all the activities, and what specific audience will you be targeting? And a revenue model, quite simply, is how are you going to make money? Who will pay you for this, and how will you reach them? But this, as the foundation, knowing what you're doing and how you're planning to make money is key. We talked a lot about revenue and capital. Revenue is dependable. It's in and out. It's sales. Capital can be explosive. It's what takes you to the next level. Knowing what you need money for and then able to match it to the type of money it is key. And a lot of times we confuse them. Oftentimes we get mad. This is one of my experiences. If you're frustrated, it's because you've confused the type of money. You want capital to be predictable like revenue and to just come in without a lot of questions, or even vice versa. It can go the other way too. So knowing the difference about what you use it for and where it shows up, revenue on your P&L and capital on your balance sheet. Short-term versus long-term needs. The short-term, money in, rent, payroll, just the everyday business expenses, often is revenue. Long-term needs, the stuff that will really take you to the next level, future growth, technologies, possibly equipment, that is capital. And again, knowing who to go to for what is critical. So takeaways from the first session: why do you need money? It will help you find it a little faster. Why you? Why would people prefer and refer you, as we love to quote from Lean Impact? And remember that financing is a tool to get someplace. It's not an end in and of itself, even though oftentimes we will see a lot of headlines around raises. But what we need to be watching for is what happens next. And the story we're telling ourselves is, to what end are we raising money?
So before, about 10 years ago, if you wanted to get someone to invest in your business, which means they'll take possibly a piece of your equity or ownership or sales, there was a process, and it was only a limited pool of people who were accredited investors. But with President Obama's Jobs Act that passed in 2012, starting around 2016, that field got blown wide open. People who are not accredited, friends, family, members of the public, could start contributing to a campaign and crowdfund those individual contributions to support you through an investment that's crowdfunded or grouped together. And the process to do that, it varies by the type of crowdfunding, but in general, next slide, please, thanks. But the general process that you have your business or your business idea and you write up an ask. Sometimes it also comes in a presentation, like a slide or a video format. You apply to a pitch platform. There are ways you could do this on your own. It's not recommended, and there are a lot of rules behind doing it on your own. But generally, you apply to a pitch platform like Kiva or WeFunder. And if they accept you, you agree to the terms of the pitch, and then you launch your campaign. And they have different parts. Sometimes you engage first your friends and family, and then they open it up to the larger crowd. But you engage them through media, social media, through email, through friends of friends of friends, to get them contribute individual contributions that are again combined together to make your raise, to make the amount of money that you would receive. And then once you receive that, again, depending on the platform, you might have to report back on it. You might have to repay it if it's a type of a debt or loan crowdfunding. But definitely what you want to do is, after you get the money, is to say thank you and keep people apprised of what you got, the money you got, how you're using it, and if there's some hiccups along the way as you're trying to use their investment. Next slide, thanks. There's lots of benefits to crowdfunding. Of course, capital, it's helpful to raise capital, but often people speak about beyond that. It's a chance to either build your community if you haven't already started it, or to leverage that and build it even deeper. And not just a community who'll be your customers, which is of course also nice if they buy something besides investing in you, but you want that community to help deepen your ability to provide goods and services that are of value to them, and also to be able to open up and get more connections. A lot of people have gone through Kiva, for example, mentioned in addition to the money, they got connections for business-to-business contracts, people who want to give in-kind investments to support them. And it's a great way to see, is that great idea that you have, is it really something that the market wants? You can test it by seeing if there are other people interested, not just your friends and family, but beyond that, the greater crowd of people who might find your product to have value in it. And most importantly, as we're looking to stack capital, you're stacking your sales, you're going after crowdfunding. Sometimes more advanced crowdfunding platforms, for instance, WeFunder, will be looking to see, have you crowdfunded before someplace else? So having that first experience with, say, a Kiva or a Kickstarter to demonstrate your ability to go through a crowdfunding is important. Next slide. And also for your investors, we mentioned with the Jobs Act, more people who are unaccredited could start investing. But this also means that people who want to support you but don't have thousands and thousands of dollars, some platforms, they can come in as little as $10 to support your campaign. It means that people who normally are locked out of supporting their local community and businesses because of cost, they can do so. And people often, they want to buy your products, but they also want to make sure that you're there for the long haul, that beyond buying something from you, how can they support you so that you're part of their community fabric for a while? And this is a way that they can do that. Next slide. Now there's some ups and sometimes there's some downs. And this is true probably for any type of financing product that you pursue, including advanced financing. It does take some time to apply. You do have to be willing to be active and engaging with your community and your customer base. And again, if you don't have one, don't be worried. Everyone starts from somewhere. We can help you with that. And we can also connect you to other resources to help you with that. And depending on the platform, there are fees sometimes to apply. There are fees based on how much you raised. And how much you raise on one platform might impact your ability to raise on future activities. Perhaps if you didn't raise enough, another investment platform might want you to raise more, or maybe you've raised over the amount that you're allowed to for the year, and you have to wait to pursue another raise before the requirements around that. So it's something to check out as you're pursuing this. There are 5 types of crowdfunding: donation, reward, membership, and debt. You can check out our webinars to hear about each of them. And also we have a lot of deep information about a particular debt model called Kiva. The DSLBD runs the DC Kiva Hub. But today we're going to talk about equity and possibly the debt components of the WeFunder platform.
Okay, sorry, I was just answering Denise's question in the chat. So talking about how to finance your business. I mean, the difference between revenue, right, what we talked about, it's like a lot of times your personal savings or the money that you make from becoming profitable, you invest that into your business. That's oftentimes how we get our internal investments. But sometimes that's not enough for the kind of expansion you're looking for, those bigger investments, and it's necessary to go start looking for external capital, which we refer to as other people's money. 2 major sources of that we're going to be talking about, that we went into more detail in webinar 3, or debt and equity. So debt, that's basically when a company borrows money, but there's a promise to pay back that money borrowed, the principal plus interest. And you can think about your traditional bank loan. You borrow $100,000, 4% interest, 10-year term. Equity, on the other hand, is when an investor gives you money and you basically are sharing the very ownership in your business with that investor for that exchange. So just like any type of investment, there's pros and cons. For debt, you get to retain full ownership of your company. With a lender, once the term of the loan is and you've paid back your lender, your investor, you no longer have any relationship with them. Interest is tax deductible. So any interest that you do pay to an investor reduces your taxable income. For most types of loans, you kind of understand when you sign the loan, like what are the predictable payments that you'll have to make every month, and you can kind of forecast for that. And it's a little bit simpler than equity financing to wrap your head around. For a new company, though, not every investor sees that you have a track record that you will be able to make those predictable payments back. So it is more challenging for a new business to secure. And then even when you can, they may ask you, an investor may ask you, okay, we need you to put some business assets up or personal assets up to secure the loan in case you don't pay me back. And whenever you have a balance sheet, right? So we talked about capital living on your balance sheet. If you have a lot of debt on it, it may make other investors weary about coming on because they feel like you're too leveraged. So you always want to think about, okay, if I'm raising debt as my form of investment, will I be able to get other types of investment further along? And you often need to have some kind of revenue already happening in your business so that an investor can look at it and say, okay, I can see the pathway for these people to pay me back. And another thing is interest rates are often, we're living in a very volatile environment. Regarding interest rates, you don't know exactly what you will be able to secure with the lender. Next. Equity. So investors are not creditors. That is actually, even though you do have to have the shared ownership, the con of that side is that if your business is not successful, the investors kind of have taken that shared risk with you, so you don't have to pay them back that equity investment. When you have more equity investments, you may still, your balance sheet looks better to maybe an investor who says, okay, I will still lend you money, because debt investors actually are paid back first and before equity investors. We talked a little bit about that in the third webinar. You don't have the pressure of monthly payments. Equity investors are paid back in different ways, often through either dividends when you're profitable or when you exit, meaning you sell your business or you have another round of funding. And during that time before you do pay back your investors from an equity thing, there's no interest accruing in most types of equity investments. Concept, like I said, you will have shared ownership, which also could mean shared control. Those investors could have a say in how you run your business, what kind of markets you take and whatnot. So it's something to consider. Time consuming to obtain, for sure. And then the reason why Camille talked about the crowdfunding has come about is that it is an exemption in which you don't have to register with the SEC, and the platforms often take care of a lot of that. And so just kind of high level debt, those are more your typical loans, equities, where you share ownership. And then we did discuss in some detail hybrid, which are kind of convertible loans, convertible or safe agreements. And really the thing to understand about some of the hybrid types of capital is that when you are an early business, often the hardest thing to figure out if you're going to sell your business is, well, what's the value of it? If an investor gave me $100,000, do I give them 10% of my business? Do I give them 50%? And some of the hybrid capital options kind of allow the investor and the founder to make that decision later down. So here today, we're going to be talking about crowdfunding. So that fits on the equity side of things, at least what we'll be discussing today. So what is equity crowdfunding? So that's basically where a broad group of investors can fund a private business in exchange for equity. Just like we said, there are other types of crowdfunding, like the GoFundMe, where it's more the donation based, or rewards, or there are some debt crowdfunding options as well. Businesses, they create profiles. They have really kind of, to the investor, a very solid presentation about what it means for an investor to give them money. That's, you do have to be willing to share your financial information. You have to really present kind of an overview of your business to make the investor think, okay, this is great. I'd like to get involved with this. It's very distinct from rewards and donation based. And basically, you would want to check them. WeFunder is obviously registered on with the SEC, but there are several other platforms we have linked here that are also available for everybody to investigate.
We're really excited about this edition, and so Pooja and I will be tossing some questions to Ade. But Ade, could you introduce yourself? And this will not go on nearly as long as we would like it to. So apologies in advance for only getting to a handful of questions, but our goal is really to give you some specific insights about the WeFunder platform itself. Ade, kick to you for a hello and let people know the great experience that you bring to this conversation today.
Absolutely. Hi, I'm Adi Akufo-Affle, currently head of WeFunders Venture programs where you work with individuals who are either early stage investors to individuals who are influencers in the space of investing and to VC firms, government agencies, and beyond. So currently, I'd say my background stemmed from having my first initial startup based out of West Africa. Sold that 4 years in for a hefty, I guess, sum, and then started working with a company called Partech. Partech is a sub-Saharan based African uh, VC firm that usually invests later stage, mostly like Series A and above. Did that for about a year and 6 months as a financial controller. At that point in time, hadn't graduated yet. And so they said, hey, if you want to actually move up in this field, you better basically go back to school. And so I ended up coming back to the US, tried my hand at a few startups. Really love the space of just investing into startups and helping more smaller, smaller based businesses. And so later on, well, WeFunder ended up picking me up as a venture partner about August 2019, and I kind of grew out their network in upstate New York and Rochester for a bit. And then they said, "Hey, do you want to take this on the road?" I said yes, and then COVID hit, and then they're like, "All right, we're bringing you internally." So then I became head of inbound, and now we've switched over about, I think right now I'm going to be 2 years and 9 months in WeFunder to date. So really looking forward to answering any questions around WeFunder in general, Reg CF, and even out external fundraising as well.
It's great. Well, Pooja, who you've just heard from, and us, we have a few questions to ping you. I'll go kick off first. What do you see are those key characteristics of a successful WeFunder
Mhm.
crowdfunding campaign? So asking you really to zero in on your platform on this form of fundraising.
Absolutely. I think what we've seen for companies who are looking to launch is that they have a strong community. If you don't have a strong community, it's going to be very difficult for you to raise funding at the end of the day. The majority of your fundraising is going to be coming from your community. Anywhere between 60 to 70% of your raise is going to be coming from individuals within your network who really believe in the product. This can be anything from friends and family wanting to jump in to customers who really adore the platform to just followers and fans of you if you are an influencer wanting to basically invest into you and the product in general. From there, it's around messaging afterwards, how you're basically getting out your message to these individuals. I usually tell folks to prepare, especially when it comes to marketing collateral. Make sure if you hit a milestone, you already have documentation set for that milestone, so you don't have to think about it when it actually happens. Is more instead of being reactive, you've already planned ahead, and you're basically posting. And at the same time, always being open to additional forms of engagement. Anything from like investors from our network reaching out to you and basically having a one-on-one to individuals basically looking for PR opportunities on your behalf. So just making sure you're fully engaged at the same time, your community is prepared to help you push your campaign forward.
Can I ask one follow-up question? What if you don't feel like your community has the ability to write big checks? What are indicators that your community is strong enough to
Mhm.
help you do this?
Absolutely. So one of the biggest things we've seen is, especially for a lot of our early stage startups, is the engagement factor first, right? So how engaged your community is. Will they be able to share your messaging out there, even though they might not be the ones writing the check? Are they willing to go ahead and post about it, about why they love your product? That's some of the biggest things we've seen. The more individuals are able to see that your community is engaged in a capacity where either they're buying your product or they are showcasing your product externally to individuals who may not know about it, all the way to possibly even I think what we've seen is founders engaging with their community. So even if, let's say, a small check size comes in, and the minimum again for WeFunder is $100. If you have $100, you can invest into a company. And so if, let's say, the founder sees that a community member is invested into their startup, sometimes they may even give them a shout out saying thank you so much, and then that gets reposted by that individual. That helps out at the end of the day in terms of the strength of the campaign. It's not always about how much you can invest, but just in terms of kind of being a supporter at the end of the day and making sure you're sending out the message is another key indicator for a lot of investors, especially on the platform.
Yeah, thank you so much, Adi. Have you seen that there are particular businesses that find more success using the crowdfunding platforms?
Absolutely. I would say for us, we're fully agnostic. That's one of our go-tos. We're fully agnostic in terms of the kind of companies on the platform. However, we've seen a lot of consumer-based businesses definitely do really well, just due to the fact that it's usually a CPG product or software focused on an individual. And so most consumers at the end of the day are able to write a check in. Sometimes we've also seen a lot of B2B based businesses who are dealing with more enterprise level companies do really well when it comes to targeting individuals who utilize the product. So like not the client at the end of the day, but the end user, being able to invest into the product because they love it so much. So what we've seen, especially I think recently, especially for B2B businesses, are companies like Mercury Bank who utilize, who basically create banking services for a lot of founders, and those founders wanting to invest into the product because they are the end user. And if Mercury Bank one day does IPO, it's like, hey, look, all the money that we may have given them gets paid back to us and some. So in terms of industry, fully agnostic, but definitely more of a consumer focus at the end of the day.
And then
What
in
is,
terms of, oh, sorry.
go ahead, Pooja, sorry.
In terms of kind of like a business, is there a particular time in their life cycle that they would do better? Is it like somebody that's like, more in a startup type of phase, or is it more mature because at that point you've got a lot more active users?
So I would definitely gear it towards the amount they're looking to raise. Usually in the early stages, let's say you have a product, you've done a little bit of testing, and some people love it. It's probably the friends and family raise, right? So usually it's the three F's: friends, families, and fools. Folks that just truly believe in you and just want to make sure that hey, if we believe in the concept and we want to get you to the next level, and so we're going to invest at the earliest stage. Usually for our platform, that minimum has to be 50K. If you can cross the 50K threshold, we allow you to basically receive that funding. And for me, I think for most earlier stage companies, 50K is where I would target for them. Just due to the fact they don't want to give up too much equity, especially at a time where their traction hasn't really been can't really be showcased, right? And then after that, it's more or less a later stage company where I'm like, hey, always give up 10% of your round towards your consumers and your community. You're going to need to raise 90% from possible VCs or possible angels who are more strategic at the end of the day, but you still want your consumers in there because those are the ones who've gotten you to this stage. And the more buy-in you have from them, the longer term they will become like you'll keep on being your customers at the end of the day. So that's the way I usually try to set it up around. But usually at an earlier stage, I would focus more or less on friends and family rounds where it's mostly your consumers and individuals really who love your product coming in at the end of the day and helping out with that initial amount. And then as you keep on raising more funding, then start hitting different segments where it's maybe 10% or maybe it's 50% because you have such a strong community. A great example would be Curlmix, where they went after VC funding, they went after individuals who were a little bit more of an expert. However, they were basically beaten down due to the fact that they wanted a smaller valuation, as in the VCs wanted them to come in at a lower valuation, but they didn't want. They were like, no, we know exactly what our product is worth. They ended up raising 5 million from just their consumer base, right? So individuals who love their product so much that they said, hey, look, we just want to be a part of your journey and basically push this forward. I'm not going to say that's always the case, right? It's definitely a case by case basis. But in terms of showcasing, hey, if we have demand for a product and your consumers love you so much because you've built such a tight knit community, it definitely helps out in the long term.
Great. We have a question from our crowd here is because no money is free, what costs can a founder expect to pay to WeFunder to prepare to be on your platform?
Absolutely. So there's no upfront cost in terms of the platform itself. And I was going to say, like, no upfront cost for the platform itself, right? In terms of preparation beforehand, if you're looking to raise above 107,000, or I'm going to say 107,000, even though the SEC has definitely like said we can raise up to 124,000 now without having your financials reviewed. I'm just going to go ahead and say 107 because they could pull that out like in the next couple of months. So to say 107. So if you're looking to raise, let's say 107 or less, you just need to have your financials done in general applied accounting principles. So it's just your income, balance, and cash flow statement, right? And so you can raise up to 107,000. If you go past the 107, we can still keep on taking investments for you. However, you will not have access to those investments until you have reviewed financials by an independent CPA. So those may cost you anywhere between $800 to $2,000 per year of financials, and the minimum we need is 2 years of financials, unless your company has just been recently incorporated and you don't have 2 years of financials. At that point in time, we'll just take financials from when you were incorporated till now. Other costs may be marketing costs you may be doing. Maybe you want to host an event to basically like launch it, or you want to start doing digital ad spend. That is on you. However, for us, we're milestone based in terms of our platform. If you hit the 50K milestone, we'll share you out to our 1.5 million registered investors on the platform, who will get an email on a Thursday saying, hey, look, this company just launched. This is what they're currently doing. Come check them out. From there, we see about a 30% open rate in terms of those emails. And then next is if you hit 100K, we'll go ahead and start doing digital ad spend for you. So we'll put about $1,000 into digital ad spends for the month to see where we can get the conversion. If we get more conversion, we put more money in, because the more money you make, the more we make. At the end of the day, our overall cost is 7.5% of what you raise on the platform. But for that, we file all the necessary paperwork. We deal with the K1s at the end of the year, which is like a tax document that you need to provide to your investors at the end of every single year. And so we'll do all of that for the remainder of basically your campaign's life or your company's life at the end of the day, unless at some point in time you end up basically having your cap table management platform outside of us, right? And so that's something we can definitely talk about at a later stage for most companies. But as of now, we'll basically take care of everything for that 7.5%, and all the documentation in terms of how the platform will basically aggregate everyone into one on your cap table is done through us.
Okay, thank you so much. We have another question from the audience about what if a founder realizes they gave away too much equity or too little funding using WeFunder? Will they be able to correct any dilutions that they feel like they've made to ownership?
Yes, during the campaign, as long as no funds have been taken out of it, right? So for us, like from the earlier statement, we only will charge 7.5% of the funding that you raise. And so when we give you or send you the money, we'll take our 7.5% out of it. There's no upfront cost to the founder whatsoever. However, let's go ahead and say, for this example, the founder has already taken out 20K of the fund or 50K of the funding so far that was on the platform, and now they want to go ahead and reduce the value. I mean, they want to either raise the valuation now. What will happen is that we will have to make an amendment where the individuals who previously invested have to agree that the valuation is now certain. If they don't agree, the founder has to then go ahead and reimburse those investors at the end of the day. So it's always going to have to deal with some kind of change, an amendment to the contract. But that's where you may see anywhere between a 20% to a 30% drop in individuals basically re-signing the confirmation regarding the new valuation changes.
Got it. Yeah. So it's really important for people to feel confident about kind of the valuation they come in offering at the start.
Absolutely. And at the end of the day, if let's say you've closed out your campaign and now you're rethinking that, unfortunately, those documents have been signed by those individuals. And so there's no way for us to change that after the campaign's been finished.
Right. And I have one more question to you, and then I'm going to pitch back to Camille, because we're going to bring in another voice into our conversation, who is raising and also brings an investor eye. So
GJ3.
My last question for you is, what is the number one mistake that you would have people avoid so that it increases their odds of being successful? What's the one thing that you just can't do this if you're going to be most successful?
Know the value of your community, right? If you believe like inside that, hey, my community is definitely going to jump on this, and this is going to be fantastic, and this is going to be great, I always say test it out, right? We have so many tools on WeFunder in terms of how you're able to test this out to your community beforehand, where it's pretty much, hey, utilize um, a type form. Basically, send it out to all the individuals you believe would actually invest, and see whether there's engagement and how much they would invest, right? And then take that number that they currently have, and at that point in time, you may be looking at anywhere between a 30% drop in terms of those individuals basically wanting to jump in. But as long as that number surpasses what you would take at a minimum to basically get your campaign up and, I mean, to get your company up and running, then let's go ahead and launch it. I think we've seen a lot of companies who've come in saying like, yes, this is like, we're going to easily blow through. This is going to be very, very simple. And it's kind of difficult at the end of the day because they haven't engaged with their community to see beforehand if there's interest associated with it. So that's what we've usually seen. But we would love to provide those tools, right? At the end of the day, if you're able to hit a minimum of that amount that we're able to go ahead and basically now like the 50K amount at that point in time, whatever you're looking to basically receive at that point may be helpful, right? So if your minimum is 50,000, but you're okay with basically raising an additional amount from individuals who don't know you, let's go ahead and do it. But if it's going to be a struggle for you to hit that initial 50K, I think there's a way to basically look at it in terms of external other platforms that may have a different minimum. And we're not the only platform out there, right? So usually I like to say if you're looking to raise less than 50K, I can go ahead and send you over to some other platforms that fit those requirements, where you can just raise anywhere between like 10 to maybe 50,000, and that's fantastic, right? That's still a great way for individuals to basically raise funding from their community and have it basically done through a regulated platform. And if you're looking to raise more than that, then it's like, here's the value add to it. So there's definitely different platforms that work with different individuals based upon the amount they're looking to raise. And then also in terms of the stage of funding or the kind of funding you're looking to receive is also one. I usually say for small businesses, you may be looking at a price round for your company, unless like if you want to give up equity in your company, you're going to be going for a price round versus a safe note or convertible note because it's much easier to provide dividends on those. If you're a company that just needs a lot of cash flow, hey, let's introduce you over to somebody that's dealing with more inventory or inventory focus, where you're just going to be either paying them back on a fixed loan or a shared revenue loan. It's all based upon where you currently are in your stage of fundraising, and if it's easier for you to either sell equity in your company or take out other forms of loans associated with it that doesn't give up any equity in your organization. So I guess that's it in a bundle. Sorry about that.
Sarah's right at the top. We could go on, and we shall. Don't go away yet, Adi, because we have some questions still coming in. But we wanted to bring in someone who Adi knows very well, Gary, who I swear every place I turn around, there's Gary. He wears so many hats because he's not just doing for himself and his business, but for communities. He's doing what we're doing here with the crowd building for capital pilot here in DC. He's doing that in Philadelphia. But today we have him here as the business founder who actually is going through WeFunder right now. I wanted to bring in Gary to share some of the experience and take some questions from the panelists and from the audience. Welcome, Gary.
Hello, thank you for having me.
There we go. Oh, let's get you off mute and let me know if you can't.
Yeah, can
If
you
you're
hear me
able
okay?
to. Yes, we can.
Sweet.
Welcome.
Awesome, awesome. Thank you for having me. I'm excited to hopefully provide some value to everybody who's interested in crowdfunding because like you said, we are doing it ourselves and we also help other business owners get set up too.
Well, tell us a little bit about Bison Ventures and how you came into pursuing a crowdfunding investment, and specifically with WeFunder. And then Sarah, Paula, and Pooja might ask some additional questions as well. And if you're the audience, feel free to drop your questions in the chat or at inno.ed@dc.gov. Gary?
Awesome. Yeah. So Bison Venture Partners is a new company that I founded with my classmates at Howard University. So literally last year around this time, I was starting my MBA journey, and at our orientation, everyone was introducing themselves and talking about the impact they want to have in their communities as business leaders. And we said, you know what, we could each do our own thing, but we believe in having a collective impact. So what if we combined our talents and started a business together? So that is how Bison Venture Partners got started. And we're on this mission to build a more equitable world and help both startup founders and small business owners get access to capital. while also creating quality jobs in our community and opportunities for everyday people to become angel investors. So we do a lot of different things, but we develop our own products, such as a coffee product we sell. We have our own lifestyle and apparel brand that inspires our community to become entrepreneurs and investors. We consult with startup entrepreneurs, small business owners to get them investment ready. And then we get to partner with great platforms and companies like WeFunder as well.
Awesome. Thank you so much. Gary, I have a question that kind of relates to when you decided to do crowdfunding, how you thought about making the offering that you felt were right. So you didn't end up with, like what we were talking with Adi about, like worrying that you were diluting ownership too much or giving away or taking on terms that didn't feel right.
Yeah, no, that's a great question, Pooja. I think someone said it in the chat, but asking your community is really key, right? So, we had never crowdfunded before. We're a brand new business. Really not much of a business track record to raise on, but we have all of our personal and professional track records that we could contribute to a strong campaign. So Adi may have mentioned this already, but when you start a campaign, you have to do what's called test the waters to raise your first 50,000 in investor interest. And that was a really great opportunity for us to basically experiment and say, okay, if we were to make this offer to the community, would they be interested in investing in us? And through that, we made the assumption that since we're a new business, it would make more sense to go with a debt round than an equity round. Um, and since you're testing the waters, you sort of have the flexibility to change, over time if you're not getting that investor interest. But our community sort of had this resounding response that they wanted to support us. So we doubled down on that and then ended up filing our Form C and making it an official raise in April of this year.
Congratulations, Gary, and that's mad respect for all of that. Can you speak a little more specifically about testing? Like, what is, for people who might not be familiar, like, what did you do? And to the degree you could be specific, like we sent an email, we wrote an email, we had a spreadsheet, so people can envision what it means to really test the waters.
Yeah, it's funny. So we're learning as we go, but we started by setting up a campaign on WeFunder. WeFunder makes it really easy to get started. So, if you already have some form of a pitch deck and a video, you can upload that directly onto WeFunder and have your campaign, live, have your Testing the Waters campaign live within, 30 minutes to an hour. So, after we set up a quick like pitch video, put that on YouTube, we put it on LinkedIn. We just announced it to the world, right? We all have our own like email list as well. So we sort of compiled them all together and sent out this Testing the Waters campaign to our email list and said, hey, everyone, here's something new that we're building. And, we would love for you to be a part of it. And of course, you have to direct everyone to your campaign page to see the specifics about, the terms you may be you may want to raise on, all the specifics about your business. But we just tried to create some marketing materials to drive traffic to the campaign page, and the email list and LinkedIn, as well as Twitter, were probably the most powerful platforms for us to market through.
How many people responded? What's a crowd? What is a crowd? How many people in the crowd have to say yes for you to move forward and feel like you're on to something?
Yeah, well, that's a great question. I mean, a crowd is definitely, I would say a crowd is like a dozen people, but you might be surprised. Like, you may not need to really raise from a crowd. You may offer this opportunity up to the crowd, but you may find that there are angel investors in your network who are willing to come in and give you the 50,000. So you may not necessarily need to raise from lots and lots of different people. It could be a few people coming together and writing larger checks. For us, it has been us raising from lots and lots of different people with smaller checks. The minimum investment is just $100. But just from us being consistent over time and building a network as well and building a brand and proving to people that this isn't just something that, oh, we just spun up, to do as like a class project, or like we may or may not do this thing. It's like, hey, we're building this business and we would love for you all to be a part of it. We're inviting everyone to be a part of it. And just all the traction that we've gained over time has, I think, instilled more confidence. And it has like galvanized this crowd to starting to follow us over time, where we really didn't have a crowd following us before.
Gary, is there one thing that you would say to a funder who's thinking about raising and they're preparing for it? Like, what's one piece of advice that you would give them?
That's a great question. Let's see, one piece of advice if
One
you're,
or two or three, whatever
yeah,
suits.
I probably have a lot, but I would say, don't underestimate the power of your community, and don't underestimate how great you are as a founder. I think a lot of business owners out there have followers, they have a crowd, they have people who enjoy their products or their services or just enjoy seeing their updates on LinkedIn regularly, and they're literally just like waiting for an opportunity to support you. But it isn't until you create an opportunity like this do they feel like they can actually do something, right, and take that next step. So I would say, don't underestimate yourself. I would say just give it a shot. Testing the waters literally costs no money, to put yourself out there. And I think you'll be surprised when you see, like, wow, my community really does want to support me. And it's more than them just like buying my products or posting about me online. Like they want to be an investor, whether it's a, short-term investor, long-term investor, they want to help me grow this company. So I think a lot of founders should just put themselves out there, one, and then again, like just stay consistent. Like our campaign has been very challenging. We've been raising for several months now, but we keep making progress and we keep learning, strategies about what works, what doesn't work. Um, so I think also just the other tip is to be comfortable experimenting and iterating over time with your campaign.
Awesome. This is helpful. So helpful. One question this is actually for both of you. I think that we've been talking to businesses about how they need to kind of make that value proposition for their own companies. I would want to ask, like, what really sets WeFunder apart? So that for Adi, and then for you, Gary, like, why is it that you chose to go with WeFunder to do your platform?
Um, So for us, I'd say one of the biggest things that sets us apart is the fact that we have no upfront costs whatsoever, right? Our founders were building this for founders to make sure that they were able to actually utilize the platform with no upfront fee whatsoever. And also, we were the first ones to actually bring this regulation to Congress at the end of the day back in 2012, which just put us ahead of the curve in terms of like how we're able to provide resources, how we go around our product, how we go around payment systems. Um, and at the end of the day, we take no equity in your company, right? So for us, it's we want to make sure our biggest value is the fact that you're engaging with your community, they're able to buy into you and your product. And at the same time, we want to open up opportunities for more individuals outside of your network to actually invest into regions such as yours and companies such as yours. So at the end of the day, it's slightly as though we're selfish, right? The biggest benefit to us is we're so selfish, and we want to make sure that we're being the best we possibly can and getting your product, your raise on our platform in order to help you guys out at the long term by providing you more resources for you to grow, and then from there, one day pay back your investors and make sure that the platform basically helped you get to that, like put you on that podium at the end of the day. So that's why I think one of the best platforms out there due to the fact that at the end of the day, it is that we're looking to help you raise more funding. But the more you do, and us being the platform at the end of the day to help you get to that level, makes it better for us at the end of the day.
Yeah, I would echo everything Adi already said. But everything he said is the key, because he mentioned that there are other platforms that startups and small businesses can use to raise funding. Um, but you really want to make sure that you're partnering with a platform that has real people behind it who really want to help you succeed. And, first of all, like WeFunder is the most accessible, in my experience of all the platforms, because the power is in your hands as a founder. Like you can go on and set up your own testing the waters campaign within 30 minutes to an hour. And other platforms require you to, go through an application process, and then a small minority of founders who apply are actually going to be able to raise on the platform. But WeFunder really empowers you to take it upon yourself, to do the work. And if you can prove that you can raise the minimum 50,000 in commitments, then you can most likely go live with your campaign. But also the team. Like Adi is an amazing individual, amazing person to partner with, and he's got all of these incredible insights from working with so many different founders and campaigns that you can apply these different strategies to your own process. So I think that's the biggest thing.
Yeah, thank you guys so much. This has got us even more excited about the crowdfunding pilot. So thank you so much for your time. Now we're going to go over a little bit of Q&A about the application process. As a reminder to work with us for coaching and also to get ready and recommended for the WeFunder platform.
So I see the questions coming in, and I could talk another hour with both of you. So I'll share at the end how we can connect with you afterwards. But I see some questions coming in, so we'll definitely circle back if we have time. If not, connect, get the answers back to you from Ade and Gary. But a couple of updates. So we've gone through our 4 webinars in preparation for some great coaching that you could receive to help you get raised ready. So if you've heard enough about crowdfunding in general, specifically equity investment crowdfunding, and you're interested in exploring it and you're a DC-based business, we encourage you to apply for free coaching. This is Raise Ready coaching available from 20 Degrees and the Marigold Effect to help see where you're at, make some recommendations on how to prepare to move forward, and then they'll do a referral on people who are Raise Ready to WeFunder to Adi to see if they can start a campaign. So again, you need to be a DC-based business, so that means you're incorporated, actively incorporated, licensed and operating. You should have attended at least 2 of the webinars. If you haven't, there's still time to watch them on demand. Space is limited, so our project that we mentioned at the top is focused on trying to get all founders, including women and BIPOC founders who are generally not represented as well in the investment space, to get them more access to this type of financing. So space is limited, and we'll prioritize those type of founders as needed. I'm going to turn it over to Paula to talk a little bit about the application, how to get to these great free services.
Thanks so much. So we have an application open and ready. We will be putting the link in the chat, but it's also linked within this webinar itself, within the PDF of the deck, essentially. Definitely come with a business plan or a pitch deck ready. There is space for that to be uploaded. All answers are confidential, and we are asking that it is completed by October 4th at 2 p.m. So again, we'll throw that into the chat at one point. And I think Camila's on it. I see her typing. And yeah, and we'll go from there. The platform will look like this blue one here at the bottom, my right. And yeah, we'll go from there.
So thank you again for joining us. I feel like we could go another hour, but we are not able to. Here's the information for our great partners. I'm asking Ade and Gary if they could put their contact information in the chat, how people could connect with you by the website or LinkedIn. But here's how you can reach 20 Degrees and the Marigold Effect, Sarah, Paula, and Pooja. Next slide. And just a recap, if you'd like more information generally on this topic of crowdfunding and equity investment through crowdfunding, our webinars are available on YouTube. I'll have this one up hopefully tomorrow if WebEx cooperates. We have a couple of guides. So the capital readiness guide that was created for this project by 20 Degrees, that's been emailed to all registrants, and soon that'll be online at our dcbusinesstoolkit.com website, which is our portal for all great information about businesses, including for DC businesses, including financing. So there'll be a roadmap with a link to that, as well as any other guides that are created. And then again, to recap, you can get coaching services for free through this pilot, and that's the link to apply, and I'll drop it in the chat. If you'd like just general information about business development, feel free to reach us at inno.ed@dc.gov. That's the DSLBD team that I'm working with for this project, and we'll be able to meet with you one-on-one or answer your questions by email. If you have specific, want to be updated about specific opportunities related to business financing, please subscribe to our DC Business Funding Alert, and there's the link right there. Next slide. Well, thank you so much again for coming to another Money Mondays. Just to let you know that there's audience points information in the chat. Paula's dropped the link for the application in the chat. And I can send out how to reach. Oh, and there we go. Bison Ventures, their link is there too. So thanks again to 20 Degrees, Bison Ventures, and WeFunder for joining us today. And we look forward to seeing you at our next Money Monday, which will be in October, about Kiva, another crowdfunding platform. This is a debt-based crowdfunding platform, also with no fees. So check it out. We'll keep you posted. Have a great afternoon, everyone. Thanks for joining us today. Bye.
Thank you.
Bye. Thank you, everyone.